Hello, I'm Mark Nardini, Head of Restructuring and Recoveries, and today I'm joined by Lisa Attenborough, Head of Debt Advisory. Today we're going to be having a discussion around what the post-COVID world might look like, the market for 2021 in terms of the debt side and also the restructuring side of things. It's great to see you, Lisa. How are you?
I'm really good, Mark. How are you doing?
Yeah, really well, thank you. So, Lisa, to kickstart us off, how does the post-COVID environment compare to the GFC in 2007?
Yeah, it's an interesting question, and it's one that's particularly relevant because the 2008 credit crunch feels very fresh in our minds still. It definitely still feels like quite a recent event, and equally one that had a global impact in the same way that the pandemic is also having. But it's a completely different time now in the lending community. We've got a depth of capital to the market that we didn't have coming into the credit crunch. And in fact, it's actually because of the credit crunch that the debt market has been able to respond so well to the effects of the pandemic. Post GFC, the rise of the debt funds meant that borrowers have got a wider range of capital sources to tap into at different leverage points and at different price points. In addition to that, banks are absolutely better capitalised, and that's because of the regulatory changes that came into play following the GFC. So that means they're better protected this time around as well. And then, of course, leverage was at a much lower point than it was back in 2008. But I think the main difference between then and now is the response that we've seen from debt providers. We've all heard stories or experienced situations back then where lenders were very quick to react. I mean, you must have seen it yourself, Mark, in your line of work. They were very quick to react in terms of calling loan defaults and looking to implement refinancings or capital restructurings. But this time around, it's completely different. Lenders have demonstrated flexibility, and where possible, they've really tried to work with borrowers to avoid loan defaults where possible. This has been demonstrated in a range of things, but most notably the provision of covenant testing holidays of up to 12 months, which has been welcomed. Of course, we're coming up to the 1 year anniversary now of the first lockdown in the UK. So it's going to be really interesting to see what happens from March onwards, because whilst forbearance is obviously it's been welcomed, it isn't a sustainable long-term solution for lenders.
Some really great points there, Lisa, that I definitely echo, and certainly the sentiment of the lenders being far more robust and well set up, and the regulations that came in that have assisted that process means that the debt environment appears to be very healthy at the moment, and that has a critical play on the health of the whole environment. So I think you're absolutely right in highlighting those points. Yeah, really, really positive.
And Mark, of the various lender types that we work with and that you work with, are you seeing more or less restructuring requests from any particular lender type at the moment?
I think at the moment there isn't actually that much distress in the marketplace. We certainly haven't seen the impacts coming through, and we don't know what the market looks like, mainly because of the support, the regulations, the moratoriums that are in place. And I think until that band-aid's ripped off, we don't actually know the current state of the marketplace. The one thing I will say is, and lenders are taking this very seriously, is they don't want to see distressed loans or loans in a poor performing position. They really want to work with their customer base to try and either continue their performance or bring them back into a performing position. So I think that the forbearance has definitely been happening, and I expect lenders to work very closely with their customer base. But unfortunately, as we know, there are loans and particularly areas of the property sector that this might not be possible for, and of course we will see an element of distress and certainly enforcement that comes through. Lisa, I suppose one of my queries really is, going forward, what's your outlook for 2021 for the debt markets?
So sentiment is gradually improving, definitely helped by the successful rollout of the vaccination, and of course the fact that Brexit was concluded with a deal. Both of those are factored into lender sentiment at the moment. In addition to that, investment activity, transaction activity in 2020 was subdued, particularly during the summer months, which means that many lenders didn't hit their new loan origination targets last year. So many are now actually actively seeking new opportunities. They have fresh targets for 2021, and they need to hit those targets. However, we are seeing a flight to quality. Lenders have appetite, but they're really keen to back the right sponsors and the right transactions in the right sectors. I've talked before about seeing a polarization of lender appetite towards different sectors, and in 2020 we saw retail and hospitality lending dry up quite considerably. In the hospitality sector, however, now we're starting to see some green shoots, which is really positive. We've been contacted by a handful of debt funds over the last few weeks who buy into the long-term viability of the sector and are actively looking for opportunities in that space. But there's still a price premium being added to those deals. There's still a bit of price discovery going on at the moment. Clearing banks are still approaching transactions with caution, but again, we've got to remember they don't just have exposure to commercial real estate loans. The clearing banks also have corporate level exposure to, say, major retailers or major hotel operators. I think, in summary, though, I believe the outlook for 2021 is one of cautious optimism. The market's responded well, and we have by no means experienced a kind of widespread credit crunch. But we also know that, as I said a moment ago, the lenders have given borrowers a breathing space of 12 months via the covenant testing holidays. So it's going to be interesting to see how that plays out in the latter half of 2021. On that point, Mark, what's the outlook from your perspective for the 12 months ahead?
There's currently limited distress in the marketplace, Lisa, and so until we know what that position looks like in terms of support being withdrawn and us being weaned off that support, it's going to be very difficult to say what the market in the future looks like. But it's certainly something where people are looking at opportunities for the future, and it's going to be an element of watching and waiting, but also cautious preparation. Lenders are far better prepared and far more resilient than they were post the GFC, and therefore that gives us a good grounding for the future in terms of the debt market adding into the healthy environment of the property sector. As we've already touched upon, a healthy debt market is key to the overall thriving environment of the economy generally, but also in particular the property market. And so I think with that in place, we do have a bright and prosperous future ahead of us, but it's going to be hard work that's required. Currently, what I'm seeing in the marketplace at the moment is lenders cautiously reviewing their loan portfolios and their appetite to risk. And whilst I think because of the well set up nature of the loan and debt markets, we will start to see a more regular and cautious approach to reviewing that portfolio setup. Lisa, one thing that strikes me here is, and referring back to London, is from a restructuring perspective, it's been relatively quiet. And I suppose we touched on the point of flight to quality. And in that sense, London at the moment has remained relatively robust in my world. How are you finding things at the moment in terms of the debt market relative to London?
Well, so when you talk about London loan origination, city offices, city office financings immediately spring to mind. And of course, there's this ongoing question around, will there still be demand for offices going forwards? The general consensus that we are hearing from lenders is that yes, there will be demand for offices in London because they are backing and financing a range of office schemes at the moment. I mean, whilst working from home last year to begin with, it was a bit of a novelty. I think most people would now agree that that novelty has started to wear off. It's not ideal on a long-term basis. People are missing the human interaction, the spontaneity of discussions, of ideas, and certainly within the property sector, we're missing the social aspect of work, right? So we're all missing that. And I think that's kind of echoed in lender sentiment towards that subsector. But while lenders are broadly positive about the London market, I guess the real question is whether the tenant and lease profile that they have previously taken comfort in is going to look the same as it did pre-pandemic. And to answer that, I'd say we are looking at two large speculative office developments in the city at the moment, and we have seen significant lender appetite for each of those. I mean, that would suggest that debt providers are taking a long-term positive view on lending against city offices.
I think that's absolutely right, Lisa, and I think that's a great summary. One of the things that I'm conscious of is we focused in quite a lot on COVID, and I know we've had Brexit as well. But there are other things coming forward at the moment, particularly in the office sector, which are of consideration, such as ESG. And I know that some of our colleagues are going to be touching on that in separate features.
It's been great talking to you, Mark. Thanks for sharing your views. I think, look, from a debt perspective, the market's in a really good position at the moment. We've got relationships with over 200 debt providers across the UK and Europe, and whilst yes, some of them are taking a more cautious and conservative approach to new loan origination at the moment, others are seeing this as an opportunity to support borrowers and to deploy more capital exactly where it's needed. So look, our outlook for 2021 is definitely of cautious optimism.
Brilliant. Likewise, Lisa, fantastic to talk to you. And I think from my side, there's an element of watching and waiting and seeing how the markets develop, but also how we continue to react to COVID.